Hello everyone, welcome to BISP Solutions. BISP Solutions is a tech company that provides technical solutions across the world. So today we are not here to talk about complex financial theories or big corporate jargons. We are here to talk about our business, our money and our future. So if you understand how much you are earning, how much you are spending and how much you need to save or invest, you really understand the basics of the financial modeling which we are going to study today. So this webinar is all about making finance simple, useful and practical. Whether you run a shop, provide a service or manage a household budget or plan to start something of your own. So we will take you through easy concepts like how to know if your business is growing, how to understand returns and profits in simple terms, and how to use financial modeling as a tool, just like a calculator, to make better decisions. So sit back, relax, and enjoy this journey where we will be connecting finance to our daily life with real world examples, stories, and a lot of clarity. So let's begin the exciting session of turning numbers into powerful business decisions. So in our previous session, we have understood relative valuation, price to earning ratio, enterprise value to EBITDA, price to book ratio, EV upon sales, dividend yield, buyback yield, total shareholder return, beta, regression approach to beta, and bottoms up beta. So before moving forward to our what is relative valuation, we should have to take a look on what we have done in our previous session about our intrinsic growth rate. So we have made a raw financial statements where we have linked our balance sheet and cash flow statement in a proper format, and then we have converted that format into 5 years data only, and we have taken and linked our data as per the heads we want, and also we calculated the total current assets, current liabilities and net working capital, not non-current assets, gross block, everything we have calculated. After that we have calculated invested capital, EBIT and ROIC. ROIC is return on invested capital, whatever we have invested the capital in our business and what returns we are getting on our on our capital is our ROIC. ROIC is our return on invested capital, right? So in 2020 we are getting 153%, then in March 21 we are getting 86%, and March 22 we are getting 101%, and like that it is fluctuating, right? So after that we have calculated our reinvestment rate where we have taken net capex. Net capex is our capital expenditure done, right? So we have calculated it by taking from our raw FS, which is raw financial statement, and we have done a small calculation of our cash flow statements where we have added our fixed assets purchase and fixed assets sold to get our net capex, and we have dragged it till the March 24. Then change in working capital for 20, it is not there, so we have taken for March 21. So we have deducted our 2020's data, 21's data to 2020. So we get 337 as our change in working capital, and then we have dragged it till the March 24, right? Then EBIT we have calculated as our above calculation only, we have linked it with that, and then we have dragged it till the March 24. Then we have taken marginal tax rate, which is hard coded because we are taking it on our own. It is not linked in any of the sheets we have taken in consideration. So I have taken 25%, as whenever a business is running for a long period of time, they will be taking tax rate as 30% or 25%. I have mentioned in my many webinars about the same thing, so keep that in mind, that 25% to 30% we will be taking for our long-term business, right? Then if we want to calculate our EBIT, which is 1 minus t, so what to do in that, we have taken EBIT, which is our 1864.21 into 1 minus our tax rate, which is 25%. So we will be getting 1398.158. and we have dragged it till the March 24. Now if we want to calculate our reinvestment, so for that we have taken a sum of our net capex and change in working capital, and once we have entered it, so it will be giving us reinvestment of 852, and we have dragged it till the March 24. So as the years passing on, there's a fluctuation in reinvestment. In 21 it was 852, in 22 it was 804, in March 23 it was 361, and in March 24 it was 3107. After that, if we want to calculate our reinvestment rate, so how to do that? So we have calculated our reinvestment rate by reinvestment upon our EBIT 1 minus T. So we will be getting our reinvestment rate, and once the calculation is done for March 21, we have dragged it till the March 24, right? Then if we want to calculate our 4-year of average, so what to do in that situation? If we want to average out our reinvestment rate for 4 years, as we have calculated for 4 years, because 20's data is not available as of now with us, as we have taken 5 years data only for calculations, right? So if we want to take out 4-year average of reinvestment rate, so we will be taking formula as average, which I have used over here, and I have taken the reinvestment rate from March 21 to 24, and once you click on enter, it will be giving us 4-year average is 66.73%. and if we want to calculate our 4-year median, so we will be using median function, and again the same range will be selected for calculation of median. So here we get 4-year of average for our reinvestment rate and 4-year median for our reinvestment rate, which is 71.08, right? Then coming to our calculation of growth rate, so March 20 will be same as here only. Now I have taken two topics over here, reinvestment rate and ROIC, which we have already calculated over above. So in reinvestment rate, we have taken this particular, which we have calculated just in our previous session. So I have linked it with my this reinvestment rate column and then dragged it till the end. Then coming to my ROIC I have calculated above. It is this. So we will be taking from 21, so 86%, and I have linked it with this hat, and it was dragged it till the March 24. Right now we have to calculate our intrinsic growth. So for that, what we will be doing, we will be multiplying our reinvestment rate with our ROIC, which is return on invested capital, and once we enter it, so we will be getting this much amount, or we can say it in percentage of growth. So we remove some of, like this, okay, and once the calculation is done, we can drag it till the March 24, and the same formula which is used over here is copy pasted till the end, and the same formula for averaging out of our intrinsic growth and our median for our intrinsic growth is same, right? So this is how we make our intrinsic growth rate. In today's webinar, we will be making our DCF model. So before moving forward, we will be understanding the previous sessions learning that what is relative valuation. Relative valuation means finding a company's value by comparing it to other similar businesses, just like people check the price of similar houses before selling their own. Businesses use valuation multiple to estimate their worth. This method does not depend on internal forecasts like cash flows, but rather on market-driven ratios such as PE, PB, or EV upon EBITDA. So for example, as we have understood the example also, here in relative valuation, as we are running a restaurant which is making profit of 10 lakh rupees yearly, and nearby restaurants with similar profits are selling their businesses for 1.2 crore, which means they are valuing their earnings above their profit, right? So 12x times they are valuing their business. So our restaurants in that way will be of 1.2 crore if we also value our business. Okay, so what is relative value? In Infosys and TCS are often compared using PE ratio. If Infosys has a PE ratio of 20 and TCS have a PE of 25, so it shows TCS is priced higher for each rupee of profit. If Infosys is growing faster but has a lower PE, investors might see it as a undervalued, a common use case of relative valuation in stock markets. Okay, so relative valuation helps investors, analysts, and businesses owners quickly gauge value by what others are worth, right? Then comes our price to exchange ratio, price to earnings ratio, right? So PE ratio tells us how much investors are willing to pay for 1 rupees of a company's profit. It's one of the most popular valuation tools in investing. So for the same, the formula is PE ratio is equals to market price per share upon earnings per share, which is EPS. So for an example, let's take an example of if a company's share is 200 rupees and its EPS is 20 rupees, so our PE ratio will be 10, right? So this means that investors are ready to pay 10 rupees for every 1 rupees of profit, right? So as we take companies example, Hindustan Unilever company often trades at a high PE ratio, sometimes over 50, because investors expect consistent growth, strong brand power, and steady profits. In contrast, ITC has a much lower PE, making it attractive to investors looking for undervalued opportunities. So PE is useful when comparing companies in the same sector. A low PE could mean a company is undervalued or it may be in trouble. A high PE can mean overvaluation or strong future potential. So if it is like this only, if my friend's company share is around, if my friend's company is earning around 1 lakh rupees per month and is priced 12 lakhs, so the PE will be 12 lakhs and the PE will be our 12. So if our shop is earning 2 lakh rupees per month, so our worth will be 24 lakh as per the concept over here, right? Then comes our enterprise value to EBITDA. So EV upon EBITDA is used to value a business by comparing its total worth, which is enterprise value, to its earnings before interest, tax, depreciation, and amortization, which is EBITDA. It's better than PE for companies with debt since it considers both debt and equity. So for that, formula is EV upon EBITDA. So let's take an example for the same. Our enterprise value is 100 crores and our EBITDA is 10 crores, and if we calculate our EV upon EBITDA is 10x, right? So it means the business is valued at 10 times its annual operating profit, right? So for an example, Zomato doesn't show regular profits, so PE is not useful in that case, right? But EV upon EBITDA gives insight into its core operating performance. Analysts use EV upon EBITDA to compare Zomato with global food delivery platforms like DoorDash or Swiggy. So EV upon EBITDA helps comparing companies regardless of their capital structure, which is debt upon equity. It's often used in M&A deals where total value matters, right? Then comes our price to book ratio, where the price to book ratio compares a company's market price with its book value, that is net assets or shareholders' equity. It shows how much investors are paying for every 1 rupees of net assets, right? So for the same, formula will be market price per share upon book value per share. So let's take an example for the same thing. If our stock price is 100 rupees and our book value per share is 50 rupees, so our price to book ratio will be 2. So this means that investors are paying 2 rupees for every 1 rupees of assets. Okay, so for an example, banking and insurance companies like SBI or LIC are often valued using PB ratio. If SBI trades at a PB of 1.2 while HDFC Bank trades at 3.5, it means the market expects HDFC Bank to be more efficient with its assets. So if two shops have the same net assets but one is priced higher, the buyer assumes that shop is more valuable because of better location or high future earning potential, right? Then comes our EV upon sales, which is enterprise value to sales. So this ratio is used to value companies with low or no profit, especially in early stages. It compares enterprise value to total revenue upon sales. So for the same, formula will be enterprise value upon revenue. So for an example, our enterprise value is 100 crore and our sales is 25 crore and our EV upon sales, which is 4x. So it means the market values the company at 4 times its yearly sales, right? So for example, startups like Paytm, Nykaa and Policybazaar often have low profits or losses. In such cases, PE can be used, so analysts apply EV upon sales to compare them with similar global companies like Amazon or Shopify. So it is useful for tech, retail or SaaS companies in early growth where profits are low but sales are growing, right? Then comes our dividend yield, where dividend yield shows how much a company returns to shareholders as dividend relative to its share price. Formula for the same is annual dividend upon market price, right? So for an example, our dividend is 5 rupees per share price is 100 rupees and dividend yield we are getting as 5%, right? So this tells investors how much return they earn just from dividends, right? So for an example, ITC is known for its high dividend yield, which is sometimes above 4 to 5%, making it attractive for investors seeking regular income. In contrast, companies like Infosys and Reliance reinvest most of their earnings and give lower dividends. So again, an example, if we are buying a rental property that gives 10,000 rupees per month rent, so if property cost is 20 lakh rupees, the rent yield is 6%, which is our passive income interest we are getting in return, right? Then comes our buyback yield. Buyback yield is the percentage of a company's market cap that it repurchases in a year. It is another way of returning value to shareholders apart from dividends. For the same buyback amount, for the formula, buyback yield is equals to buyback amount upon market cap. So for an example, if a company buys back 1,000 crore worth of shares, so market cap of 50,000 crore will be there. Sorry, if a company buys back 1,000 crore worth shares whose market capitalization is 50,000 crore, so buyback yield will be 2%. So for an example, TCS and Infosys regularly do share buybacks. This increases their share value by reducing the total number of shares, improving per share earnings. Investors see this as a sign of confidence, right? So think of it like a group business with 10 partners, okay? So 2 partners leave and their shares are bought back. So the remaining partner shareholding increases. Just like that, buybacks boost shareholders' value, right? Then comes our TSR, which is total shareholders return. So TSR is the total return an investors earn, including capital gains plus dividend plus buybacks. So for the same, formula is ending price minus beginning price plus dividends plus buybacks upon beginning price. Okay, so it gives a complete picture of what investors earn. So for the same, let's take an example. Over 10 years, Asian Paints has consistently provided high TSR due to price appreciation dividends. Similarly, Infosys has delivered a solid TSR due to both capital growth and share buybacks, right? So TSR is the best indicator of real return to shareholders, not just stock price growth, right? Then comes our most important is beta. So beta measures how much a stock moves in relation to the overall market. So if beta is equals to 1, then stock moves same as market. Beta is more than 1, then stock is more volatile. Is if beta is less than 1, so stock is more stable. So for an example, Tata Motors have high beta because auto stocks are sensitive to market and economic changes. HUL, a customer staple company, usually has beta less than 1, more stable, right? So think of beta like shock absorbers. High beta is a race car, fast and risky. Low beta is a scooter, stable and predictable, right? Then comes our regression approach to beta. So to calculate beta, analysts use regression analysis, plotting a stock's return versus market returns and finding the slope of the line. So this slope is equals to beta, which we have already discussed in our regression, that the slope which comes out is beta, right? So it shows how much the stock tends to move when the market moves. So for the same, analysts calculate beta of Infosys by regressing its weekly returns against Nifty 50. So this helps portfolio managers decide how much risk they are adding to their portfolio, right? So regression like comparing your shop's monthly profits with the city's average and seeing how closely they move together, right? Then comes our next topic, which is bottom up beta, which is used when a company is private or not yet listed. We take betas of similar public companies, unlever them, remove debt impact, and then adjust it for the company's capital structure, right? Then comes our example for the same. So valuing a startup bakery, you can take beta of listed companies like Jubilant Foodwork, unlever them and adjust for your bakery's debt to get an approximate beta, right? So like it is like guessing your shop's performance based on how nearby shops perform after adjusting for how much loan you took, right? Then coming to our DCF modeling. So before moving to this DCF modeling, we will be making a sector data which will be required in our DCF modeling or valuation. So what we will be doing, this is my sector data of India and I have downloaded it or copied, you can say I have copied it from the Damodar site. So it will be looking like this. This is the Damodaram online, and for the same we have to go to our data. Under data we will be getting our current data. In that we have to click on current data and come down to our cash flow estimation, where we will be getting capital expenditure, depreciation, reinvestment rate and sales to capital ratio by industry. And once you click on that, you will be getting whole data for industry, number of firms involved in this industry, and depreciation, capital capex and depreciation, acquisition, net R&D, net capex sales, net capex EBIT, sales investment, and like that. You have to just copy it and paste it in the same sheet so that you will not lose it whenever you require it, right? So I have copy pasted over here, and as it is all the columns are there, but what I have done extra, that I have taken out my reinvestment rate and expected EBIT growth, so that once I move to my DCF modeling or valuation, then I will require this reinvestment rate for my companies and expected EBIT growth, which I am expecting that it will be growing. So for that, I have already calculated it. So for reinvestment rate, what I have done over here, I have taken if error function, so that if there is no data available, so it will show me dash or 0, right? So I have taken if error 1 divided by my sales or invested capital LTM and comma 0, and when I clicked on enter, it will be showing me reinvestment rate, and I have copied it till the end, as the calculation will be same, only the digits and column and rows will be changed, right? For expected EBIT growth, what I have done, I have taken if error again, and I have divided 1 by my reinvestment rate, and I will be getting my expected EBIT growth, which is 419.00 percentage, or we can say 419 percentage, right? Okay, so I don't want these two. You can do for like this. If you don't want, you can just do this, right? So that this completion of sector data is done. So we will be moving forward to our DCF modeling, right? So firstly, we will be doing what? Calculation of PV of FCFF, right? So FCFF is our free cash flows of firm, right? So for that, we will be taking EBIT, which we have already calculated in our data sheet over here. It is, which is EBITDA. We are taking last year's data and these 5 years for our forecasted data. So for EBIT, we have taken from our data sheet last year's data, which is 10,650, and I have deducted my depreciation, so I will be getting my EBIT. Okay, now my tax rate will be 25%, which I have already told you all. Then when I want EBIT into 1 minus T, so what I will be doing, EBIT is this into 1 minus my tax rate, so I will be getting 886.455. Then I will be reducing my reinvestment rate, which I have taken it from my intrinsic growth rate. Reinvestment rate is this, right? So reinvestment rate is 64.23%, right? So how I have taken it from here, because in my intrinsic growth, I am getting my growth as 64.23%, right? And in my sectorial data, I have taken Asher Motors, so it will be coming in retail automotive, so it is giving me reinvestment rate of 40%, or we can say 40% only. So if I want to reach to this place, so what I have to do that I will be taking this particular March 24 actual data, plus I will be doing a absolute anchoring on my March 29 forecasted data, and I will be deducting it with my March 24 actual data and will be dividing by 4, because we want 4 years data, right? So how much it will decrease to reach to this particular point, right? After that, free cash flows to firm, how to calculate that? I have done calculation as EBIT, which is multiplied by 1 minus reinvestment rate, and we will be getting 317.0743, and this is not required. After that, expected growth, it is asking us. So what we will be doing, we will be linking it with our intrinsic growth rate statement. Here we have taken our expected data, and the terminal growth rate is our 5.38. It is official in RBI site, you can check that also. And WACC is taken from our WACC data, which I have already told you all to copy the data of the companies and paste it in the same format so that it will be calculated on automatically. So our WACC was 20.044. So now if I want to calculate for my March 25, I will be calculating it by EBIT of March 24 actual data into 1 plus my expected growth rate, which is absolute anchored, and I have dragged it till the March 29 forecasting, right? And the tax rate will be the same, right? After that, EBIT will be the same as we have done for one, like that only. This is also same, and free cash flows to firm. So I have taken it from my EBIT into 1 minus my reinvestment rate, and I have copied it till the March 29, right? Now coming to our mid-year convention. Mid-year convention is we are doing not 1 year's data's calculation, we are taking it for 0.5, which is mid-year, right? So for that 0.5 is there, we will be doing plus 1 in our 0.5 mid-year convention and dragged it till the end, right? If I want to calculate my discounting factor, which is 1 divided by 1 plus our mid-year convention, which is absolutely anchored to the power r 0.5 years. So I will be adding 0.91272 and dragged it till the March 29 because our all columns are completed, right? Now if I want to calculate my FCFF for present value, so I have to do one thing. I will be doing free cash flow to firm into my discounting factor. So I will be getting 558.739 and dragged it till the end. So if you guys are not able to understand these terms, we will be learning that. Don't worry about it. Just now understand the basic things, then we will be moving to the more broader terms of the same calculations and same terms. So don't worry about it. After that, calculation of terminal value we have to do. So in FCFF, which we will be calculating it by n plus 1. N plus 1 is the years plus 1. So for that we will be doing our free cash flows into 1 plus our expected growth rate, and it is entered as 10876.14368. Now again WACC is this, so we have taken over here also, and terminal growth rate, it is already calculated in our this portion, so it is 5.38. So if I want to calculate my terminal value, what I have to do, I will be taking my FCFF, which will be divided by my WACC minus terminal growth rate, then I will be getting terminal value. So till this, I hope everyone got to know the DCF valuation we are doing for calculation of PV. PV is our present value of FCFF. So that's all for today, guys. We will be taking our more topics in our next session, which is related to the terms which we have used today. So, as we wrap up today's session, one thing is clear: valuation is not just about numbers, it's about understanding the value behind those numbers, right? Whether we looked at EBIT, FCFF, reinvestment rate, WACC, or terminal value, each concept connect us to one simple truth: a business is worth the cash it can generate now and in future. So we saw how, just like running a shop, investing, or planning for your future, these concepts reflect real world thinking. How much will I earn? What will it cost me to earn that? How much will I reinvest or save? Through this lens, financial modeling becomes less technical and more practical. You don't need to be financial expert. You just need to be curious, consistent, and conscious of your cash flows. So, thank you all for giving me your time, attention, and energy today. I hope this session has sparked confidence in you to explore financial modeling deeper, not just as a skill, but as a way of value businesses, investments, and ideas smarter. See you in the next session, where we will be continuing turning complex finance into clear, usable insights. Thank you once again for joining. Wishing you great success on your financial journey. See you in the next session.